Welcome to our first series of Friday's Fireside Chats. We are here with Amanda Landers with Union Home Mortgage. How are you?
Good. How's it going?
Thanks for
Amazing.
coming.
Happy New Year. We're coming right into it.
I know. I'm super excited for 23.
Me too. Rychen Jones, GDP Group.
Welcome. Glad to be here.
Rich and famous.
Rich and famous real estate.
Yeah.
Your wealth creating realtor.
Yeah, your wealth creating realtor. And I'm Granderath. I'm the broker here at the GDP Group. We just wanted to do something a little different this year, 2023. We wanted to get knowledge out to our community, to our friends, our family. There's a lot of misnomers going on about the real estate market, right?
Yep.
And we wanted to start it off with lending and the interest rates, because that's the big thing that's being talked about right now. And I think it's being talked about in a way that's scaring people, and it's actually not really scary. So
Right.
Can you share with us what's kind of going on with appraisals, offers? What are you seeing right now in the new year?
Yeah. So, I mean, just jumping off with appraisals, I'm seeing homes come in at value, but the appraisers noting that we're in a declining market. That sounds super scary, but it's not. I mean, it makes it so you guys as agents can go and negotiate a better transaction or offer.
We can actually do our jobs.
We get to do real
love.
estate now. Yeah.
Right. You're not
Negotiate.
over asking or appraisal gaps. It's back to normal offers where everybody has an opportunity to buy a house.
So when you say they're coming in at value, they're coming in at the offer price, meaning like back a year ago we saw, we'll offer you $40,000 above offer price, $100,000 above offer price. Sometimes they were still appraising there.
Yeah.
Now, like at offer price or even maybe a little less than asking price.
Correct.
They're coming in value, no problem. From a lender perspective, no problem. It still hit the value. Let's keep moving. Is that
Yes,
accurate?
that's accurate. And then we run on our side a collateral underwrite, which is a software that agencies like Fannie and Freddie want to see when they're purchasing files. And that grades it on a number scale 1 through 10. And last year, they all had high numbers, high ratings. They felt like the values were being pushed a little bit. Now we're back into the normal. So the risk factor as a lender on that has come down immensely.
And so when you say collateral underwrite, Amanda, for those who don't know the lingo for lending, they're thinking collateral? Are they thinking the boats they own, the things they own? Is that the collateral underwrite they're talking about? Explain collateral underwrite
so
for us.
Collateral underwrite is the home is the collateral for the loan. And so they run a back-end software, which like me as a loan officer, you guys as the agent, we don't actually get access to those findings unless it is detrimental, right? But it's a back-end report that gets put in the file. So then when the secondary market is grading that loan, A, B, or C, you're getting that information.
So it's just on the house. So we don't want people to think they're gonna.
We're not collateralizing your other assets.
Yes, we're not combining things.
We're not combining things. The collateral is just on the home itself.
Correct.
Yeah.
Correct. Yep.
That's interesting. You mentioned a couple other things as we were getting ready to start here. What else are you seeing in the market right now? We've seen a big shift this year.
Yes.
I remember we go back to our housing forecast breakfast a year ago, January, and we're not going to hold anybody to that because no one could have seen what was happening.
Yeah. Excited
but
to see it
all the different groups and things like that who project interest rates were saying, oh, by the end of the year we'll be at 3.75, and at the time we were at 2.75.
Yeah.
Obviously, that has not been the case. So has it shifted even in the last 30, 45 days? Obviously, like what are you seeing now currently?
So interest rates are really pretty volatile still. We're tracking with inflation, and I would say that is the key point of what's driving our interest rates right now is inflation. You do see some reports that come in with unemployment that can have some effect on our interest rates. But I would say like a conventional rate, you're looking in the 6s as of today. What is today? Like the 30th? December 30th. So we're in the 6s in conventional. And it's a big range depending on your interest rate and how much you're putting down. And we're in the high 5s on government loans, FHA, VA. So in the last, I would say 30, 45, 60 days, rates have been as high as 7s, mid 7s. And then they've tailored back down into the 6s and 5s. There is some predictors that think end of first quarter, we're going to see a huge improvement on rates because when they're looking at inflation, it's a 12-month average. And some of those low numbers with inflation fall off of that 12-month average. And so then we'll get to see the benefit of that And then there's other predictors that think we'll see a 4.5 interest rate coming into 2023. Yeah. What do you think that does to the market, though?
Well, so let me ask you that. So that's you were talking mid 5s to mid 7s, right?
Mm-hmm. Which is still a normal.
It's a normal rate,
market, but people right now are gasping.
But let me be the number. Let me put on my numbers hat for a minute, right?
You are a numbers guy.
What we know is that every 1% in interest rate increase is a loss of purchasing power of about 10%, right? So on a $500,000 house, we've lost about $50,000 worth of purchasing price for 1%. So you were saying 5.5 to 7.5. What would you tell someone from a lender perspective right now of, I'm just going to wait?
So I'm
going to wait to see what happens.
Here's the agent in me.
Yeah. So I would ask them, what is the cost of waiting, right? Like, before you make that determination, what is it going to cost you to wait? Because let's say rates don't come back down like these predictors say, but housing still increases because these are normal rates. And we're going to have a natural appreciation 3 to 5%, no matter what the market looks like, right? So what does that cost to you, right? It could cost you getting a house waiting. Yeah. So if you can afford a house now, why not re-budget, try to get comfortable with a little bit higher payment than what you thought you were going to get in the 2s or 3s. And right?
Those days aren't coming back.
No. And then buy now, and you're not going to go back into a feeding frenzy when rates drop. You're going to have your house and be able to refinance and always better your situation.
And a lot of us have heard, and we've said, right? We've said, marry the house, date the rate. Because your rate can always change. You can refinance, you can restructure everything. But that house is not going anywhere.
And maybe this answers my question for you. When I mentioned that to her, you had this visceral reaction of don't wait. What would you tell a buyer? How would you have that conversation with a buyer? Obviously, we're not lenders, so we have lines that we can't cross as far as how we describe interest rates. But how would you talk to a buyer about not waiting? In with what Amanda just said from interest rate side.
Yeah, and we're doing it all the time, right? You and I are on phone calls like this all the time. We always say the market will always be in a consistent change. Your life is always changing. But if this is the house and this is the time that you need to buy, it's always the time. I would not wait to buy a home if I know I need a home for my family. You need to move. You need to move on. Why are you going to pay somebody else's mortgage? You may be paying somebody else's mortgage for the next year because you think you're going to wait or the interest rate's going to get better. Well, what happens when it doesn't get better?
Yeah.
So the house prices aren't going to drastically fall. The interest rates will come up and down, but now is still the time. The time is always now.
There's historical data, there's graphs out there that we're not making up as lenders. You guys aren't making up as agents.
I hold data with integrity. Like, I love data because it doesn't lie. I don't like to make up numbers. It's there, right? The data's there.
The data's there. And even without, let's say, the COVID push for rates or housing market bubbles, there's data that says every 5 years you see rates ebb and flow. And so we're maybe coming down off of a peak.
And they were low for very, very long time, almost a decade, right?
I was joking and saying the home was pretty much free.
Right.
At 2.5%.
At 2.5%, it's pretty much free interest right now. Like, we're not going to see that again.
We were ticking up right before the COVID numbers. And I would say we were pricing, 4s to 5s, and then the market shifted, right?
Yeah.
So
I had a client who purchased a home in December of 2018 at a 5.25%, 30-year fixed. They were happy as could be. Because like you mentioned, it got there slowly, ticked up. I think what has caught a lot of people off guard is how fast it, we hit March. I think it was, we were at 4.5 or so in March. And all of a sudden, 90 days later, we're at 6.5. Just the shock of that, I think, sent a lot of people into uncertainty. I think we talk a lot about controlling what we can control a lot of times. I think that's, for me and my buyers, that as we're having this conversation, it's what do we know right now? What can we control right now? We can't control where interest rates are going to be our first quarter, second quarter next year. We can't control what our landlords are going to charge in rent when our lease comes due.
Which is going up.
We can't control inventory. We can't control housing prices. What we can control is, what can I afford right now? What are rates right now? Does this house make sense? Does these terms make sense? That's what we can control. And then we can take one step and figure out where we're at, where we are at. And maybe we need to reassess in a year or two and refinance or whatever it may be.
I think.
Well, touching on rent, sorry, didn't mean to cut you off. Some of these landlords have to make up money
Sure.
from not receiving rents, right?
Sure.
So they're not just going out there with malicious intent trying to
Yep.
put people in hardships. It's a financial decision on their part, and I think that's the other flip side of that coin is there's no high level thinking about what did all of these decisions do to our market, right?
I
There's a
think
lot of variables at play for sure.
there's always going to be variables, right?
Mhm.
It's never going to be somebody's most perfect time because somebody's always going to want something more or something less. They have it's a frame of mind. They
Right.
saw these lower numbers and they saw the big house they can buy.
Yeah.
At
Free, as you said.
pretty much free, right? They were really on paper can afford this home, but because of the interest rates and where it was, they were buying homes up here that people with income double theirs would normally be buying, right?
Correct.
So now it's going back to a normal, stable market, in my opinion. 5, 6, 7, that's not a bad interest rate at all. But they had this dream and now they have to come back to reality. And it's not like this reality is bad. These homes are still beautiful, but they have this vision in their mind now, and it's just a switch. We need to get that
or
switch and that
create
power
an
forward.
action plan to eventually get this
To
house,
get
right?
it.
Let's get into this
Yes.
house, build some equity, get in a great
Right.
financial standing, and then we can move
and
up.
then we can move up.
One of my favorite stats, and I don't have it in front of me, so we'll look up the actual data. We can link to it if we need to. Is over the last 30 years, now probably 33, 34 years in Utah, there's been a lot of market changes. Think about the last 35 years in the markets and wars and recessions. The average increase in house appreciation per year is still 3.4%.
Yeah.
And I think what we're saying, I saw a lot of my first time home buyers buying in 2018, 2019, who were ready to move up on their next house in 20 and 21 and 22 because they gained what normally would take 5 to 7 years in equity in 18 months or 24 months. I don't think we're gonna have to go back to when you buy a house with an interest rate, you probably need to be comfortable with that house and that rate for 5 years, 6 years, 7 years, rather than how quickly can I get out of this house into my next one because I want to move up. We have to shift our mentality, I think, a little bit.
Well, in talking to those people that, because the interest rate was in the 2s, they could get this higher level luxury home or whatever. There's the ongoing cost of that house. So does your budget support that ongoing cost? Taxes are rising, your homeowner's insurance is changing, right? Your cost for your family
property
grows,
taxes are
right?
Really higher. And they don't understand that. And this is where we as professionals need to make them realize this is pretty, the home is beautiful, but are you going to be able to sustain it over the the life of your
maintenance,
owner for the
right?
maintenance of it, because the maintenance may cost more than what
your budget
is. So that's the question I get a lot from the lending perspective. We talk about interest rate buy downs or various measures to ultimately get their payment lower. And one of the things I know you look at is what are you going to be paying to lower your payment,
right?
And like what's your break even point on that? If your break even point on that is 16, 17, 20 years, does that really make sense to pour all this money up front into this house if you're not going to be there that long anyway to receive the benefit?
Right.
Can you talk about like what are people doing to get their ultimately that's payment, right? We're all payment driven. We're a payment driven society.
Right.
What are people doing to get their payment lower, and when does it make sense to do that?
So some of the programs I'm just hearing you talk about are like in that statement, buy downs, a 2-1 buy down, 3-2-1 buy down, maybe an ARM program, or if you have a standard conventional FHA, you're going to buy that interest rate down or pay discount points to get a lower rate. And you've got to figure out your break even. Is it coming out of the consumer's pocket? Are we taking it from the seller? Not taking it, but negotiating it from the sellers, right? And at that point, if you're getting concessions from the seller, is that break even point nearly as important? Because we're trying to get your payment to fit your budget.
Yeah.
So if the sellers are paying the concessions and then you turn around and refinance in 12 months, but your break even's 3 years, you've got to be able to weigh that out at the beginning of the transaction to make sure you're okay with not meeting to your break even.
Yeah.
The buy down programs, 3-2-1, 2-1. Those aren't bad options. I like them for a consumer who we can sit and understand them together.
Yeah.
I call it a little bit of a teaser rate. The first year, second year, or first, second, third year, the sellers or agent has to pay the fee for the buy down. The borrower cannot pay that fee.
Okay.
And then it's set aside in an account, and the payment's fully amortized, right, over 30 years. So let's just use some round numbers. If the payment's going to be $2,000 with the fully amortized rate, then the first year the payment may only be $1,000 for my consumer. The other thousands coming out of the concession,
This account, this
this
fund.
account
Okay.
that the builder or the builder, seller, or agent's paying, and so it offsets to make sure that full payment gets made. And then the next year you get your payment creeps up another 1%.
Mhm.
So you're still in the teaser rate period, and your payment's $1,500. So now the other $500 still coming from that account. But if you refinance, I'm going to go with a 2-1 buy down. If you refinance in the first 24 months and you have a balance left in this account, they'll apply it towards your principal owed amount, principal balance.
Perfect.
And that way you could use that funds to offset a cost of a refinance. So then it's not out of pocket. You're not changing your principal balance because you're getting this credit, and then you offset it, right? Like it's kind of round math.
So I don't want to get into the weeds too much, but from an underwriting, from a qualification standpoint, let's say, does that buyer need to qualify for what that payment's going to be after the buy down runs out, or can they qualify on what the initial payment's going to be?
No, so they're going to, and I don't think I talked rate, so I'm going to use just an estimation of rate. I don't have an APR that goes with it.
Disclosures
so
all over the
yes,
place here.
I'm going to disclose that. So let's say our fully amortized rate, 7%.
Okay.
The first 12 months, I'm at 5. The next 12 months, I'm at 6. And then my fully amortized rate, year 3 to 30, I'm at 7. I have to qualify at that 7%.
Up front, you have to qualify for,
Yeah.
I think that's one of my biggest concerns is when a buyer calls me and said, this builder's offering this great 2-1 buy down, whatever it is, I can make this payment. My big concern is, well, that's great. Month 25 is going to come really, really fast. If there's a $500, $600, $800, $1,000 difference a month in payment coming 25 months from now,
what's our action plan?
What's our action plan? Are we increasing income?
Stop in the middle.
Yeah.
That's why I wanted to stop, because a lot of our viewers don't know what 2-1 buy down is. And so that's why I wanted you to explain that. If it's at 7%, that's the initial rate right now. And then their first year, they pay that 2 down. And then the next year, the 5%.
6%.
Yes. So it's 2% less than what it is now.
Correct.
And then it goes to the 1%, and then it goes to the current rate.
Correct.
Now, if our current rate, when they do their 2-1 buy down, is 7, but when they go to refinance after that is over, and if it's at 6, does that float down to 6, or do they have to stay at 7?
So they have to do a full refinance to get a different market rate.
If it is the lower. Okay.
You're saying if it's in the first 2 years, in the case of 2, in the first 2 years, there's going to be money left in that sort of that fund we're talking about that can go towards helping pay for the refinance costs.
Yeah.
So they have 10 grand floating here, and at the end of those, that buy down rate from the 7, if it's at 6, they can use that 10 grand to refinance to get to the 6.
Whatever's left.
And it's not like they're going to send that money from this account to title for a credit.
Right.
It's going to be applied to their payoff. And so we'll get a
payoff.
Yeah.
Okay.
So the payoff will come down, and then, but really we're going to use the balance, that difference, that balance.
Instead of paying off $200,000, they're paying off $190,000. Now they can use the other 10. Instead of they're getting it back, they can use it. Yeah. They're just shifting money around.
Yeah.
Let's talk
What
about
else?
really quick, because you and I are in the middle of working with a VA assumable.
Yes.
Okay, this is a big deal right now. A lot of people aren't talking about VA assumables with their clients that are veterans or can qualify for VA assumables. Right now we have a listing, and it's a VA assumable, and it's at 3.3%.
Yeah.
So let's talk about VA assumables for those who don't really know, and even agents. A lot of agents, like we were discussing, weren't aware of what a VA buy down is and what they can do with it.
Yeah, I've actually had a lot of conversations. Agents are pulling just listings that say assumable
rate.
They
get really excited. Oh my gosh, 3.25% rate. Like, let's go get this house.
Mine says it down there, capital letters.
Yeah. And it is a great option. There are a couple things, right? Pros and cons. You got to look at the list. The first thing is you cannot use your lender, your preferred lender, or If your buyer comes in with their own lender, they're not using that person. They have to go to the servicer of the current homeowner. So let's say Wells Fargo is who services the loan for this VA assumable. That buyer has to contact Wells Fargo, have the seller's name, their loan number, and then they'll do an application with them to see if they can qualify to buy this house. Now, there's a couple things that come in to play there. Is most of the time when you're thinking assumable, you need to, the understanding is the difference between what the purchase price is and what is owed is coming in cash. So that buyer usually needs that money down. I've seen where some servicers will let you go and get a second mortgage to help cover that gap, but it's not going to be guaranteed, and it's going to be a case by case. And the reason being is that changes the loan to value or total cumulative loan to value. And so now, do they really qualify for that rate?
Right.
So right now,
Let's
use mine as an example.
Yeah, let's put some numbers. Let's put some numbers to it.
Let's put some numbers. So our listing right now is at 1.1 million. My seller owes 540,000 at a 3.3%. So this new buyer coming in needs to be able to qualify for this 540,000 to assume that, and then also need to qualify above that to get to the 1.1.
Gonna have to bring in 560 to make up that difference.
560 either in cash or a second,
some sort of financing.
Some sort of financing, right? Now, as not the servicer of the VA, are you allowed to do that second or the rest of that 560?
Well, that's where the important conversation starts up front with the servicer, because the servicer may not let you pick up a second.
Okay.
And the reason being is they're going to go back and look at the original client's loan to value, and they don't want to push over that because all of that, those pricing metrics built that interest rate.
Right.
Okay.
And so it's going to be a case by case. And so typically when I'm telling agents, if your borrower's shopping for an assumable loan, they need to have some funds down because they're going to have to make up that gap. And then if that's a plan, you've got to make up that big gap, you're going to be fine. But if you have to go case by case and contact every servicer and see if you can pick up a second, then you're going to be in a little bit of a spin.
I love the idea of assumable loans, but in my mind, that becomes the crux of it. Is if I'm going to have to go get a second loan, even if I can even do it, if I'm going to have to go get a second mortgage on top of the assumable one, which as a second mortgage is going to have a higher than market rate anyway, my overall payment may just be the same as if I went and got a conventional 30-year or whatever it might be, with maybe a lower down payment, lower cash out of pocket. I think that's where we start having conversations with our clients and with our lenders as a team, where it's like, what makes the most sense here? Yes, 3.3 is a great assumable rate, but if I got to put a second on top of that and my blended rate is 6.5 or 7, and I have to come up with all this cash, maybe that doesn't make as much sense.
Right. And that's what I actually spoke about with that buyer's agent was, if they're just looking at a standard VA, the rates are in the 5s, right? If you have this 3 and then you're looking at a 7, 8, or 9, depending on the loan to value, what's our blended rate? Does it really make sense to go out? Because again, each servicer, you're going to look at their turn times, 30, 60, 90 days. What I can't even remember what that VA servicer said was 60 days. Yeah.
60 to 90, but they were hoping more like 60. But in my head, when somebody tells me 60 to 90, I'm thinking 90.
Yeah. So there's pros and cons. That interest rate is good if you have some cash to come to the table with. I feel like that's the best scenario for it. But I don't want to talk them down because each scenario is going to be different.
I love this conversation. Can we bounce around a couple things here? We hear a lot about Federal Reserve raising interest rates. They've done 3/4 of a point. The Fed meets. Mr. Powell comes out and announces it. Should borrowers get too caught up on what the Federal Reserve is doing, or how does that, when the Federal Reserve increases rates, as we hear in the news, they increased it by this much today? What does that actually mean for home buyers?
So they're increasing consumable rates, not necessarily mortgage rates, right? Mortgage rates are driven by the bond market. We've talked about them following inflation, unemployment. So the Fed rate is going to, like, dollar for dollar, affect your credit card. They're going to affect your home equity line of credit. They're going to affect your car loans, right? So those consumable debts that you can pick up, and it does make it so when lenders are borrowing money or we have a line of credit, our interest rate on that line of credit that we fund off does go higher. So cost for us as a lender per loan does change, but it's not, we're not necessarily passing that along in the mortgage interest
That's a dollar
rate.
per dollar instead. Yeah. Okay. So as a home buyer, maybe we pay attention to what the Federal Reserve is doing, but if we really want to know what a home's going to cost, we need to talk to a qualified lender.
Yeah. Talk to a lender. Let's talk about, and even if you're a current homeowner and your consumer debt is changing because of those interest rates, like you also want to have an exit strategy out of the house. Like, are you getting laid off, or is your credit cards increasing, your home equity line of credit? You're no longer on that teaser rate. Like, before you miss that payment, I think it's a big deal to talk to your real estate agent or a lender and figure out, do you have an exit strategy, or can we do some type of consolidation?
I'm so glad you brought that up. There's a lot of people. I mean, we've been out
and
about.
I know you're a numbers guy, and
meeting
I'm
with
the emotion person.
We've been meeting with our client. We dropped Christmas drop-bys. We've talked to a lot of people in the last couple of weeks, and I mentioned this to you the other day. I loved seeing all my clients for the past couple of years, and at the same time, like, those were heavy days. There's a lot of people struggling right now from a house perspective. In my opinion, the absolute worst thing you can do is miss a payment. Right. What are some options maybe that are out there right now if someone's feeling stress of, I don't know if I can make this payment, or how much longer I can make this payment?
And really quick, before we get into that, I just want to say for everyone out there, if anyone is struggling or coming up to where they're about to miss a payment, please do not be embarrassed.
No.
A lot of people are going through it right now.
Life happens, for sure.
Life happens. It's happened to the best of us. I mean, I had that when I was younger and bought my first home. Like, I've been there. And as your agent and whoever you've worked with, if you've built that solid relationship with your agent and your lender, please feel secure enough to call them, because the last thing we want to put people in homes and keep them there. We don't want them to lose their homes. So please don't feel like embarrassed, and I know it's hard. It's easy to say not to feel like that, but please reach out, because we do want to help, and we want to make sure.
And there are resources available.
And there are resources. It's just not a dead end, and we can help you get there. And you can go back into that. I just wanted to make sure people knew that.
I think that's a good point.
We are there to talk to and to listen to, and we've seen it, and we've seen it all. So it's not like you're telling us something new for the first time.
Right. And I would say your resources when you're coming into a financial hardship, first things first, before your credit score starts to tank, maybe let's look at a debt consolidation. And in that point in your mind, if your rate's in the 2 or 3s, you have to purge that out of your mind, right? Because we're not able to facilitate that anymore in our budget. So that's a hard pill to swallow for a lot of people up front. So we just have to purge that, what my current rate is, because that's not market rate. But then if we're not looking at, like, a debt consolidation, still doesn't make sense because your payments higher, rates are higher. Then you can talk to your servicer, like some type of modification or forbearance. They're not guaranteed anymore because the government's not forcing them, but the servicer does not want the cost of a deed in lieu or a foreclosure. Those are very expensive. They want to keep you in the home and keep the home maintained. And then for you guys, like, it's talking, should we be selling this house? And then with the cash that from our equity position, paying off our debt, and does it make sense to rent, or does it make sense to move into something smaller and be able to carry maintenance on that house, right?
What I hear you saying is it's far more effective, short and long term, to be proactive about it ahead of time rather than trying to react when maybe our credit score is already dropped. Maybe we lose some of the options that we might have if we got out ahead of it early on.
Yeah. I would say a lot of people do get embarrassed, and then it's hard on your mental health, and you want to just hide your head, right? But call us. Nobody's judging, right?
I appreciate all this. This has been great. We have our last question here coming from Instagram. And it's you'll appreciate this one.
Okay.
Are we seeing another 2008 situation here?
And
let's talk about that. Let's talk about it from a lending perspective. Maybe differences between then and now, and are we seeing another 2008 situation set
up?
For
those that don't know,
definition of 2008.
What's the definition of a 2008, right?
Yeah.
So
So
let's get
market
into that.
crash, right?
Yeah.
2008 was
Foreclosures, housing
foreclosures,
values
short
plummeting.
sales.
Yeah.
Yeah. Lenders were lending only almost
you
to
weren't.
everybody.
You weren't,
I
but
weren't. I
some-
wasn't.
some
I
lenders-
was
some
Have you seen
lenders
the
were.
Big
actually.
Short? If you
Yes.
haven't seen the Big Short,
Yeah. They were lending to
Student
anybody with
income.
a pulse.
You could fog a mirror, you could
Yeah.
get a loan.
Yeah. Like I remember,
Amanda,
I get a lot.
you get a
I
lot.
remember I was making 2008, I was 3 years out of college, I was making $30,000 a year, and I had someone offering me 106% loan to go buy a house. It essentially was a first and a second that would
Yeah.
cover all my down payment, all of my closing costs, and it was like 106%.
It's like a shiny.
Yeah, it was like, hey, you want to buy a house?
Buy a
And
house?
like I went through those numbers, and me, I'm a pretty conservative person anyway. I was like,
Well,
But
or they
I-
had negative amortizations
and it had, yeah,
where
that, the whole
like
thing
you weren't
was
even
like-
paying
I was the
enough to
last person that should
interest.
qualify
Yeah.
for a house at that point, and they were like, "Here, have some money."
Go for it.
Yeah.
Well, yeah, the housing market crash was like a one-time event. I feel like it was the leftover from 9/11, right? The market's jobs,
Mhm.
Yes.
and then
They're trying to spur the economy after that
Yes.
event and
there's
pumping money into the system, like kind of like now, which
Yeah.
is maybe why some people see some similarities.
Yep. So I get that, but the lending practices
Mhm.
were completely drastically different than what we are today. We're a lot more conservative as a lender. You're not going to state your income or state your assets. You're not going to be a chef at McDonald's making
Did you
20
say chef?
Yes. I'm not. I saw that application. I was processing at the time. So a chef at McDonald's making $20,000 a month, that doesn't make sense, right?
No.
Like
If it
we're
does, I'm going to leave in real estate and go to McDonald's.
The wrong
you're
business.
20
yes.
grand a month. No.
We're sourcing funds.
Yeah.
We're asking
Every
questions.
dollar.
Every
Yeah.
dollar, right? And some people feel like it's abrasive, but that's what we're doing to curb,
Try to avoid it.
to
again.
avoid that
Yeah.
market change again.
Yeah.
So I personally do not think home values will decrease, especially in Utah. We have growing families. We have a growing economy.
Mhm.
Businesses want to come here because of how we conduct
Yeah.
business,
Business
rules
in
and
Utah. Right.
regulations. Just the growth alone could spur our whole market, right? Like not on a job, like the economy, the businesses coming in on top of our family
People are still
sizes,
moving
right?
here.
Yeah.
So,
It's
and
still
then you're
growing.
always going to have transactions, marriage, death,
Yep.
divorce. Life happens.
You
for
know, I love
everybody.
this stat. NAR puts out a profile of buyers and sellers every year using millions of data points, right? Millions of houses sold. And there's a list of about 15 things of why people buy houses. I took that list and put it down to about 2 reasons.
Mhm.
Deducted it a little bit.
Yeah, a little bit more. Made it a little simpler to look at. 1 out of every 2 buyers in 2021 bought a house because of a life event.
Right.
Birth, death, divorce, marriage, health, job relocation, some sort of life event, which they're going to
Happens
continue to
daily.
happen no matter what
Yeah.
interest rates are.
Yep. And so I think those things alone will keep us from a market crash.
Mhm.
Now, people are getting scared because you hear that declining market in the appraisal, but really it's declining from what it was.
It's like it's a
It's
short-term
not
issue, right?
declining
Yeah.
your values,
So can I say
right?
something about that really quick? I have people saying all the time, and buyers saying all the time, it's a great buyer's market now. You know, you see these big deductions on the MLS, and I said, no, let me stop you there. These reductions in home prices that you are seeing are coming from a highly inflated, overpriced home because they were trying to capture that I'll pay over $100,000 for your home.
Mhm.
I said, and now what you're seeing are these deductions coming, and the prices of the home now are actually where they are supposed to be.
Right.
So these reductions in home prices aren't because we are a failing
Market.
market.
Which is why you, man, are still seeing
It's
appraisals
still
come
why you're
in
seeing
at value.
appraisals come in
Yes,
at value.
yes.
We
Yeah.
are now actually, agents are pricing the homes properly again.
Yeah.
Or sellers are realizing, okay, I can't have this fairy tale. I have to be more realistic. And
Mhm.
home prices are where they need to be.
Right.
They are not dropping because of a crash. They are coming back down to where they need to be because they were overinflated.
Which is a natural market
It's a natural
cycle.
market
It happens
cycle.
over and over
Yeah.
and over
so
again.
please know that
Yeah.
it's not crashing and you're seeing these huge deductions on the MLS and in pricing because we're in this crash or recession. It's because now homes are finally being priced where they should be
Right. So it's declining from the inflation.
from the inflation.
Think about
Um,
when you're like driving on the freeway and you're like, you got your foot on the gas pedal, right? And you're cruising along. You take your foot off the gas, you slow down a little bit, just naturally. You kind of slow down a little bit until you press the gas. And we're kind of in that pace right now where we kind of let off the gas. We're still cruising along.
Yeah, we're moving.
We're moving,
We're moving.
but we're just not, pedal
Falling
to
by.
pedal to the metal sort of thing,
Well,
like we've been for a couple of years.
Utah
let's-
and Salt Lake economies are still listed top 1 to 5, right, in the nation.
Mhm.
So I would say it's a good time to buy in Utah if you can afford. I don't see a crash coming. Maybe you're going to, like, for lack of better words, you're going to see values plateau
Mhm.
because it's not going to feel, you're not going to feel a 10, 15, 20% increase. 1 to 3 is going to feel like a plateau,
Mhm.
or that's going to make
Mhm.
you question,
Normal is
is
going
it,
to feel like a plateau, right?
Yep.
3.4 per year for the last 35 years.
yeah, you're going to be like, oh, is am I going to pay more for this house than it's
Mhm.
worth? No, because you're always paying down your principal.
Right.
Well, thank you.
Yeah.
Yes, thank you so much.
Yeah.
Amanda Landers from Union Home Mortgage, thank you so much.
Yeah. Thanks for having me, guys.
Thank you for
That
joining
was
us
awesome.
today. If you liked what you heard, or you think it's valuable, or you think someone else might find it valuable, would you do them and us a favor and share it with them? Also, if you want to not miss anything, we're going to do these about once a month, as well as a lot of other content we have coming out. You're going to want to follow us on any of our social media channels on YouTube, Facebook, Instagram. We're not hard to find there, but we are going to be putting out a lot of content in 2023 to help consumers understand what's going on in the market, how to navigate it, and so that they can know how to help explain to some of their friends who may not quite understand it as well. So,
And we'll also put the links on for
Yep.
Amanda Landers
Yep.
and Union Home Mortgage. And
Yep.
Thank you.
We'll put everything
Yep.
on there as well.
Yeah. Thanks.
thank you again so
Thank
much.
you.
Appreciate this, and we will see you guys next time.
Bye, guys.
Bye.